Hello and welcome to this video on types of analysis in Forex. Forex, or foreign exchange, is the market where different currencies are bought and sold. It is the largest financial market in the world, with a daily trading volume of over $5 trillion. In order to make informed decisions about buying and selling currencies, traders rely on various types of analysis. Let's take a look at some of the most common ones. There are several types of analysis that traders can use to make informed decisions in the Forex market. These include 1. Technical analysis involves analyzing price movements and patterns of a currency pair using charts and other technical tools. Technical analysts look for trends, chart patterns, and indicators to help them make decisions about buying and selling currencies. There are many different technical analysis tools and techniques that can be used in Forex trading. Some common ones include trend lines. These are lines drawn on a chart to show the direction of a currency pair's price trend. Moving averages. These are averages of a currency pair's price over a specific period of time, which can help traders identify trends and potential entry and exit points. Oscillators. These are technical indicators that help traders identify overbought or oversold conditions in the market. Candlestick patterns. These are patterns formed by the price action of a currency pair on a chart, which can indicate potential buying or selling opportunities. Fibonacci retracements. These are horizontal lines drawn on a chart at certain key levels, which can help traders identify potential support and resistance levels. Technical analysis can be a useful tool for Forex traders, but it is important to note that past performance is not necessarily indicative of future results. It is always important for traders to carefully consider the risks and potential rewards of any trade before making a decision. 2. Fundamental analysis in Forex involves analyzing the economic and political factors that can impact the supply and demand of a currency. This includes analyzing economic data such as GDP, inflation, and employment figures, as well as news events and government policies. Fundamental analysts use this information to try to predict how a currency will behave in the future. There are many different factors that can impact a currency's value, and fundamental analysts often use a variety of tools and techniques to help them analyze these factors. Some common ones include economic indicators. These are data points that measure the health of an economy, such as GDP, unemployment rate, and inflation. Interest rates. Changes in a country's interest rates can have a significant impact on its currency's value. Political events. Political instability or major policy changes can impact investor confidence and demand for a currency. News events, natural disasters, major technological innovations, or other major news events can all impact the value of a currency. Fundamental analysis can be a useful tool for Forex traders, but it is important to note that past performance is not necessarily indicative of future results. It is always important for traders to carefully consider the risks and potential rewards of any trade before making a decision. 3. Sentiment analysis, also known as sentiment trading, involves using social media, news articles, and other forms of market commentary to gauge the overall sentiment or mood of market participants. Forex traders may use sentiment analysis to try to determine whether traders and investors are generally bullish or bearish about a particular currency, and use this information to inform their trading decisions. There are a number of ways that sentiment analysis can be used in Forex trading. For example, a trader might look at social media posts or news articles to get a sense of how traders and investors are feeling about a particular currency. If the sentiment is overwhelmingly positive, the trader might interpret this as a bullish signal and consider buying the currency. On the other hand, if the sentiment is overwhelmingly negative, the trader might interpret this as a bearish signal and consider selling the currency. It is important to note that sentiment analysis is not an exact science, and the sentiment of market participants can change quickly. It is always important for traders to carefully consider the risks and potential rewards of any trade before making a decision, and to use a variety of different tools and techniques in their analysis. 3. 4. Intermarket analysis in Forex involves analyzing the relationships and correlations between different financial markets, such as the Forex market, the stock market, and the bond market. This type of analysis can be useful for Forex traders because the values of different financial instruments can be interconnected, and changes in one market can impact the value of instruments in other markets. For example, a trader might use intermarket analysis to look at the relationship between the value of a particular currency and the stock market of the country whose currency it is. If the stock market is performing well, the trader might infer that there is a high demand for the currency, which could lead to an appreciation in its value. On the other hand, if the stock market is performing poorly, the trader might infer that there is a low demand for the currency, which could lead to a depreciation in its value. Intermarket analysis can be a useful tool for Forex traders, but it is important to note that past performance is not necessarily indicative of future results. It is always important for traders to carefully consider the risks and potential rewards of any trade before making a decision, and to use a variety of different tools and techniques in their analysis. Thanks for watching this video on types of analysis in Forex. If you enjoyed this content and want to learn more about the world of foreign exchange, be sure to hit the like and subscribe buttons, and don't forget to leave a comment down below. We'll be back with more useful tips and insights, so stay tuned.